All right, well, welcome to the training this week. It is May 28th, and I log these dates simply so we can go back and go, yeah, Steve, a year ago when you started doing this training, all these things that you were talking about, the market's going to reverse, that was just garbage because, interest rates were so low and it got to the lowest it's been in, I don't know, decades. And even after the pandemic, all of a sudden, all these houses were for sale. People were moving, they were migrating, jobs were changing, people were working remotely. That allowed them to move to smaller communities or leave California and move to Texas, let's say, or Idaho, or leave New York and move to Florida. And there was all these big types of migration. Houses were accelerating 20, 25, even 30% year over year. And people were bidding and outbidding each other and overpaying on whatever someone had actually put on the market. And you're like, Steve, why were you telling us that all these things were going to change? Well, simply because the ability to use the equity that grew in this accelerated environment, I wanted you to be able to take the maximum amount of equity value that has been inflated by this marketplace to do what? To be able to pay off your mortgage sooner and safer, number one. And number two, to be able to take that equity position that has now been inflated because of this market and take a home equity line of credit called a HELOC and be able to do the first step, which is to capture that idle equity that's just sitting in the value of your house that a bank or loan institution will advance you. And you can get that at, let's say, 4%. And if you're over here paying 8% or 12% or 25%, the average credit card rate right now in the United States is 19.4%. And guess what? With the inflation that has now shown up that I told you a year ago was coming, we're seeing the highest rate of inflation in 40 years. You feel it every time you go to the grocery store. I drove past, actually, I filled up yesterday. 2 weeks ago when I filled up, it was $51 to fill up my car. It was $61 to fill up my car yesterday. And it's a small, like a four-cylinder, it's a Toyota RAV4, $61 to fill it up. Now, we're not at the peak yet, okay? It's going to continue to go up. There's some people speculating that we're going to see $10 gallon per gas. That sounds a little high because right now here in Oregon, we're at like 505, 510, something like that. It's already way above $6 in California. Other places I hear it's in that same level. So, can $10 really be realistic? That's a doubling rate right now. I don't know. Okay. But could we see 7? Well, yeah, because we're already at 5. We're already at 5 or 6. So what's that going to do? Well, all of that energy is the underpinning, you want to call it the kernel or the nucleus of everything that happens. Okay. So if you're moving sticks and bricks to build houses and you have to move those in what? A semi or on a train. Or, if you're moving packages, that means you got to move them on a FedEx airplane, or you're moving passengers, you got to put fuel in there. So if oil is going up, that means the cost of gasoline is skyrocketing with that oil because it takes, gasoline is nothing but refined oil. So in all of those environments, they all require the same underpinning catalyst, and that's putting bread on the shelf, toilet paper on the shelf, meat on the shelf, all those things that we require for food and services and transportation and building. All of those things are all energy related at the core. So if you see energy going up, you're automatically going to see everything else that's in the CPI is also going to accelerate. So what the problem is the disconnect is as we're seeing home prices go up, as we're seeing inflation going up, as we're seeing the mortgage rates have skyrocketed, okay? All of those things are all on this kind of vertical. And what kind of vertical do we see wages on? It's gone up, but now it's tailing off. So unless wages were staying on the same vertical that we saw with inflation, cost of housing, cost of rent, cost of a gallon of gasoline, if they were parallel to that, then we would be okay, even though all these things were inflating, but they're not inflating in parallel, okay? The rate of wages is falling off. It's not staying in pace. So what's happening now is not only are we going to go into mortgage foreclosures, we're going to go to people being evicted from their place that they're renting because their wages aren't keeping up with the high jump in rent and so anyway, I'm going to have a video that I'm going to play here in just a second. I want you to get the statistics, not just hearing my theory because you're like, Steve, who are you? You're not an expert. Well, I've been in the financial service industry for over 30 something years. So I am someone that's been around it. I live it, but I want you to listen to someone that is an expert that can give you the actual statistics to help interpret. That's what statistics are for. Statistics are backward facing analysis of what's going on with different sectors and how it's measured. Now, it doesn't necessarily predict the future, but it starts painting a picture. It's called a forecast. Anybody that's going to predict a price point in the future, anybody that's going to predict a rate, they are an idiot. I'll use that term specifically. Predictions never happen. Forecasts do. And the difference between a prediction and a forecast is a prediction is a price at a particular point in the future. Okay. They always are wrong. A forecast is a price range at a time interval. Okay. So when they give together, they give you a price range, low and high, and they give you a time interval and how soon it's going to begin and then when it's going to end. So that together gives you a forecasting ability, which is very able to be on target because it's giving you a sector or a range of what you can expect within reason based on statistical analysis. So watch the video here I'm going to share with you, and then we'll talk about it. Hang with me. I'm going to share the audio as well so you can listen to this. And here we go.
Brand new data revealed that home builders are abandoning homes unfinished as investors prepare for a housing market crash. New numbers from the U.S. Census Bureau shocked the investing world on Tuesday morning after it was revealed that the sale of newly built homes collapsed by almost 30% year over year. This massive plunge shows that from the recent peak in August of 2020, new home sales have actually fallen over 43%, putting them back on 2017 levels. The reasons are obvious. Not only have prices reached all-time highs, but interest rates have shot up to nearly 6%, making the average monthly payment unaffordable for the vast majority of the middle class. According to Redfin data, homebuyer mortgage payments surged 44% year over year. You can see by looking at this chart that the average buyer in 2020 was paying around $1,300 a month. Today, that number is well over $2,400. Based on these revelations, many experts are forecasting that the new home market is going to crash in the near future. Their reasoning is simple. There are just too many homes being built right now and not enough buyers. An important metric called housing starts, which tracks the number of homes actively under construction, serves as yet another piece of evidence for this trend. Right now, the reading is at 1.728 million, which is a recent high, approaching the 2007 high of 2.2 million. But the concerning fact is that while this number continues to rise, new home sales are plummeting. So simple logic tells us that building while nobody's buying points to the disaster scenario. This might be the first time in US history where we're seeing such a trend. Economics tells us that when demand is falling but supply is increasing, the result is a price adjustment, aka a crash. Investors are also realizing this, and you can tell by looking at the stock of home builders. D.R. Horton, Lennar, and Pulte Group are the largest home builders in the United States, and one quick look at their stock price tells us everything you need to know. D.R. Horton, as an example, is down 34% from its peak. Then we can also add in the fact that most traffic measures are down as well. Mortgage purchase applications fell to their lowest level since May 2020, and the number of home buyers touring and offering on homes as measured by the Redfin Homebuyer Demand Index posted its largest annual decline since April 2020. Now, listening to all of these stats, you would think that the
Okay, so let's talk to, what do you think of watching that video there, Gunny? What does that look like to you? Just a simple analysis of stats with red markings and yellow highlights.
It's going to suck. It's going to be like it was in, was it 2007, 2008?
Yeah, when we had
when it crashed.
Well, there are some things that if you want to watch this entire video, I'll put it down in the description so you can watch it. It's a particular channel that I watch. There's another channel that I watch as well called Reventure. I'll put it in the link as well down in the description. You know, you have to, again, go back to, this is one person that I like their perspective, and I only gave you two and a half minutes of a 7-minute video, so you can watch the entire part of it. He argues in a good analysis, and he takes the devil's advocate position So he doesn't necessarily say this is doom and gloom. He actually works to show you why this might not be a duplication, or what is it called, the redux of 2008, where everything crashes. And he's actually showing that still with the market demand, we're seeing us hit the apex and starting to move down the other side. Here's the deal: is when you get past the peak, what you hope is that it's a slow, gradual, and then finding a new norm in the marketplace. Okay, so it's a price adjustment that he mentioned, moving back to some new level of normality. What we don't want to see is a spike and then a drop like we saw in the NASDAQ in 2008, where you saw this huge vertical sell-off, okay, where everybody that had chosen those stocks or had money in an ETF or a mutual fund or whatever that was invested in their 401k, they saw their retirement fund just destroyed, okay, 50+% in a matter of months. Now, what didn't happen in the rest of this argument of this video is that even in that entire environment, we only saw house prices in 2008, even with the overbuild, we only saw a 20% reduction in value. In some specific areas of the country, we saw a significant difference because they were too overbuilt. One was Phoenix. I think the other one was Las Vegas. And I forgot where the third one was. But my point is I'm going to give you the channels. You can go do your own research. The point of the matter is what we're going to start seeing is the value that we want to be able to tap that's inside of your mortgage is now going to start reducing again. All right. It's at its peak. It's already gone past its peak. And I've been jumping up and down for a year going, get all of this value that you have sitting in your mortgage and use it for what? For a good reason. It is an inflated value. You didn't do it. The market did it. You don't have to sell your house. You are not going to change your underpinning fixed mortgage. You leave that the same. So what are you doing? You're using the inflated value that's happened in our marketplace because of the pandemic, because of all these other factors and demand and blah, blah, blah. We don't care. The value is that it's there. Why don't you use it for a great, better option? I mean, we're seeing the utilization of credit cards because of inflation, the highest utilization of open credit lines ever before, I think, in history in the United States right now. So people are maxing out their credit cards. Well, what are they paying as an interest rate on their credit cards? 8, 12. The average is 19.5. People are paying even 25 and 30%. Well, simple math. Okay, we don't have to be geniuses here. If you're paying 20% on a credit card, and I can get you a HELOC that can get you at 4%. In fact, I can get you a starter rate at 1%. 1%. 4% is where it's going to average at. And I can get you the only HELOC in the marketplace that instead of being a variable rate, I can get you a fixed rate on the HELOC. So I got you an opening rate at 1%. It's actually 0.99. I got you a ongoing rate at 4%, and I have you a convertibility. If that 4% moves up to 4.25 or 5 or 4.5, and we see it starting to increase, you can convert the variable rate that might go to 6 or 7 or 8. I can convert it to a fixed HELOC at 0.75%. So if you're at 4.25, I can convert it to 5. If you're at 5, I can convert it to 5.75. But it's the only one out there that will convert to a fixed HELOC. So let's say we convert it and we get you to 5.75, worst case scenario, and you paid off a 20% credit card line, and you paid off an 8% auto loan, and you paid off a 12% roof installment loan when you fix that. Isn't it just smarter to pay a lower rate than a higher rate? It's common sense, but Mark Twain said, common sense ain't so common. So my whole point is I keep feeling like I'm, a wolf out here hollering at the moon, and a few people are listening, but now it's become gravely important that you pay attention. Why? Because now that we've hit that peak of home values, now we're going to see that value on your home start to reduce, which means the HELOC value that I can access to do all this incredible stuff like pay off your high interest debt, actually be able to use it to accelerate the payoff of your mortgage, the fixed mortgage, separate from the HELOC, that number is now starting to come down. So you're not going to be able to get as much to pay off the high interest rate that I told you to go get a year ago. So is it over? No. Is it still there? Yes, it's still available. So the thing is we need to act. We need to act quickly. People that you know, love, and care about, connected with me. I will show them how to use the value that's sitting in the home right now called equity, separate and above your mortgage. You're gonna leave the mortgage the way it is. Don't touch it, never move it. But I'm gonna show you how to pay off all your high interest debt using a lower interest rate. And then when we pay off all the high interest consolidation, we're then gonna take the HELOC and we're gonna accelerate the payoff of the actual mortgage itself. Why? Because we're gonna be able to use a system called paycheck parking. Now, all that's part of the program. I do this because this is part of our referral group. This is part of individuals that are wanting to help other individuals. I do a video every Saturday, same time, same place, that gives you an up-to-date perspective. Why? Because you don't have time to do that. We're all busy doing other things. This is something that I watch, that I do all the time. Why? Because I'm a nerd. And when I come home or I'm finished doing appointments every day, I don't go watch the news because I don't listen to sensationalized propaganda. I go turn on YouTube and I go to channels like MHFIN and I watch videos like this because it educates me and it's not specifically sensationalized. So that's where we're at today. Any questions you got, Gunny?
No, not really. I'm just keeping up with information and what have you. But it's tough. I talk to people, the thing, you can lead a horse to water, but you can't make them drink.
Oh, yeah.
And man,
I know I've had,
reaching up and choking them.
I've had a lot of individuals here just in the last week or so that because inflation is like really knocking on their door finally, it's the same individuals that have been, on my email list that requested information and got a copy of my book when it came out, whatever, 9-10 months ago. And they haven't done anything. They haven't asked for an appointment. They haven't made any actions. And so now, they're making those movements. That's good. But, I wish every person on my email list that requested a download of my book was, on my calendar. But like you said, you can't make a horse, drink the water, even though you can lead them to it. So all you can do is keep leading them until maybe eventually they get thirsty. And will it be too late? I hope not. But that's not my responsibility. My responsibility is just to do the Paul Revere thing and tell them that inflation is coming. Inflation is coming. And, it's all you can do.
Yeah.
All right, my friend, good to see you. And if you have any other questions, you know how to sound off and pop flare and whatever you need to reach out to me. All right.
You got it, buddy.
Talk to you soon. All right.
Later.